Welcome to the SafeSimpleSound podcast, where our approach to financial planning creates both and solutions for the contradictions families face. We believe that true financial confidence doesn't come from chasing the latest hot stock or predicting the unpredictable. It comes from building a framework that is safe, simple, and sound. In today's episode, we are exploring a deeply common yet rarely discussed challenge. It is the story of a specific type of financial confusion. That moment when you open your account statement and feel a disconnect. We're exploring the difference between being a good investor and simply owning a good investment. This is a topic we recently wrote about on our blog, specifically because it addresses a source of silent anxiety for many families. It centers on a contradiction. How can the market be up? How can a mutual fund be performing well, and yet your personal account balance seems to have barely moved? This disorienting feeling often leads to confusing questions. You might ask, is my fund manager doing a good job? Or, more painfully, am I just terrible at this? It creates an either-or dilemma that can lead to anxiety, paralyzed decision-making, or reactive changes that might harm your long-term plan. Whether you are a seasoned investor or someone just starting to build their nest egg, this episode will give you a sound framework to measure two very different things: the performance of your tools and the performance of your behavior. Through our S3 approach, we are going to resolve this contradiction. We are going to move away from judgment and toward clarity. By the end of this 20 or so minutes together, you will understand the difference between time-weighted returns and dollar-weighted returns, and more importantly, how to use that knowledge to become the architect of your own financial stability. Let's begin by establishing the safe, simple, and sound foundation for today's discussion. In our practice at SafeSimpleSound, we often observe a specific phenomenon during review meetings. It's a moment of hesitation. A client looks at a report, sees a benchmark or a fund return, and then looks at their bottom line. The math doesn't seem to add up in their head. This is a safe space to admit that this is confusing. The financial industry often speaks in a language designed for institutions, not for families. When you see a headline that says the market is up 15% and your account is only up 4%, the immediate emotional reaction is often one of failure. However, from a perspective, we need to apply the simple filter. We need to translate what is actually happening. The reality is that there isn't just one way to calculate a return. There are two distinct methods, and they measure two completely different things. This brings us to the core conflict we want to resolve today: the gap between the investment's performance and the investor's experience. Let's break this down using our S3 framework. The traditional financial industry often forces an either-or dilemma here. They say either you beat the market or you lost, or either the fund manager is a genius or they are incompetent. But our sound principle suggests a both-and solution. The answer isn't to pick one question over the other. The answer is to have a clear way to measure the performance of your investments and the real-world impact of your own financial behavior. Think of it like a car and a driver. If you have a high-performance sports car, let's say a Porsche, that is capable of going 180 miles per hour, that is the machine's potential. That is the investment. But if you, the driver, are navigating through school zones, stop-and-go traffic, or if you constantly slam on the brakes because you're nervous about the road conditions, your average speed will not be 180 miles per hour. It might be 30. Does that mean the car is broken? No. Does that mean you are a bad driver? Not necessarily. You might be reacting to your environment. In financial terms, the car is measured by something called the time-weighted return TWR. The driver's experience is measured by the dollar-weighted return DWR. Let's define these simply before we get into our story. Time-weighted return TWR is the number you typically see in a fund's prospectus, on a Morningstar report, or in the headlines. This is the car. It measures the pure performance of the investment itself, completely ignoring your actions. It ignores when you put money in, and it ignores when you take money out. It answers the question, how did the manager or the assets perform in a vacuum? It's a clean, apples-to-apples comparison. It is a sound metric for evaluating a strategy. However, families don't live in a vacuum. Families have cash flows. You receive a bonus and invest it. You have a tuition bill and withdraw funds. You get nervous about the election and pause your contributions. This is where dollar-weighted return DWR comes in. This is also known as the internal rate of return IRR. This is the driver. It answers the question, how did my specific money actually do? This calculation is profoundly personal. It is heavily influenced by the timing and the size of your contributions and withdrawals. It doesn't just measure the investment, it measures your experience with the investment. We view the dollar-weighted return as one of the most important diagnostic tools available. It steps beyond the cold math of portfolio management and enters the warm human realm of financial coaching. Why? Because the difference between these two numbers, the difference between what the car could do and what the driver actually did, tells us a story about behavior. When we see a gap between these numbers, it's not a cause for alarm or judgment. It is an opportunity for clarity. It aligns with the principle of governance over reaction. If we can understand why the gap exists, we can build a system to manage it. This is the essence of SafeSimpleSound planning. We want to design systems where your personal return, the driver captures as much of the investment return, the car, as possible. But concepts are often best understood through stories. So, let's move into our deep dive, where we will illustrate this dynamic through a specific educational example. To illustrate this principle of the two returns, let me share a hypothetical scenario with you. Please note, while this story is created for educational purposes to demonstrate the S3 framework, it reflects patterns we frequently observe when families interact with volatile markets. The characters and the specific fund mentioned are fictional, designed to help us visualize the math of behavior. Imagine two friends. Let's call them Steady Sarah and Reactive Robert. Both Sarah and Robert decide they want to invest for their future. They both have $12,000 to invest over the course of a single year. They both decide to invest in the exact same mutual fund. Let's call it the growth fund. Now, because they are in the exact same fund, you might assume they will get the exact same result. But as we know in the SafeSimpleSound philosophy, behavior is the variable that changes everything. Let's set the scene for the growth fund. The fund has a volatile year. It's a bumpy ride. In the first 6 months of the year, fears of a recession dominate the news cycle. The market gets jittery, the fund drops in value by 20%. Then in the second 6 months, the economy roars back. The fears subside, earnings come in strong, and the fund soars. By the time the clock strikes midnight on New Year's Eve, the fund finishes the year up 10% overall. So the car, the investment, did its job. It weathered the storm and produced a positive 10% return. That is the time-weighted return. Now let's look at how our two drivers handled the road. First, let's look at Steady Sarah. Sarah embodies the trustworthy tortoise energy we talk about so often at S3. She has a system in place. She decides in January that she will invest $1,000 on the first of every month, no matter what the headlines say. In January, she puts in $1,000. In March, when the market is starting to wobble, she puts in $1,000. In June, when the market is down 20% and the news is shouting about financial disaster, she sticks to her system. She puts in $1,000. Because the price of the fund is lower in June, her $1,000 buys more shares than it did in January. She is buying on sale. She isn't trying to time the market. She is simply funding her plan. As the market recovers in the second half of the year, she continues, $1,000 a month, every month until December. Now, let's look at Reactive Robert. Robert is a good person, but he doesn't have a framework to rely on. He is driven by emotion, specifically the two great enemies of sound planning, fear and greed. Robert starts with enthusiasm. He invests his first $6,000 right at the beginning of the year. But then, the drop happens. The fund falls 20%. Robert turns on the news, hears the scary predictions, and feels the pain of loss. To protect himself, to be safe in his mind, he stops contributing. He thinks, I'll wait until things settle down. He misses the months where the fund is cheap. He misses the sale. Then, the second half of the year comes. The fund roars back. Suddenly, everyone is talking about how great the market is. Robert gets a case of FOMO, fear of missing out. He feels like he's being left behind. So near the end of the year, when the fund is approaching its high point, he throws his remaining $6,000 in. Both Sarah and Robert invested $12,000 total. Both owned the same fund that went up 10%. But when they open their envelopes at the end of the year, the results are shocking. Sarah is thrilled. Her personal return, her dollar-weighted return, is actually higher than 10%. Why? Because her steady, disciplined contributions meant she bought the bulk of her shares when they were cheap. When the recovery happened, she had more shares participating in the growth. Her behavior amplified the investment's return. Robert is devastated. When he looks at his statement, he sees that he has actually lost money. His personal return is negative. Why? Because his emotional decisions caused him to buy high in January, pause during the low prices buying nothing, and then buy high again in December. He essentially sabotaged the fund's performance with his timing. While this story is fictional, it demonstrates perfectly how the behavior gap works. From our team's perspective at SafeSimpleSound, this isn't about judging Robert. Robert's reaction was human. It is natural to want to pull back when things hurt and push forward when things feel good. But in finance, that natural instinct is often wrong. This hypothetical scenario illustrates the sound logic behind dollar-weighted returns. Robert's dollar-weighted return was poor because his dollars weren't there to do the work when the work was most profitable. Sarah's dollar-weighted return was excellent because her system ensured her dollars were present for the opportunity. This leads us to a critical realization in our S3 framework development. A sound financial plan isn't just about having good investments. It's about having a good process for investing. Through our practice, we've observed that many families look like Robert, not because they aren't smart, but because they lack a system. They are relying on willpower and emotional stamina to make decisions in the moment. And as we know, in the heat of the moment, emotions usually win. The behavior gap, that difference between the investment's return and your personal return, is simply a measurement of that efficiency. If your dollar-weighted return is lower than the time-weighted return of your investments, it suggests that your timing decisions, perhaps driven by fear or greed, are a drag on your wealth. It's like riding the brake while driving the Porsche. If it's higher like Sarah's, it means your timing has added value. And here is the most important safe takeaway from this deep dive. We can control the process. We cannot control what the market does, the TWR, but we absolutely can control how we contribute to it, the DWR. This aligns with the principle of agency. You are not a victim of the market. You are a participant. By shifting from a reactive Robert approach to a steady Sarah approach, often through automated, systematic investing strategies like dollar-cost averaging, you can close that gap. Whether you are facing this exact scenario or just wondering why your portfolio feels off, understanding this distinction is the first step toward empowerment. It allows us to stop asking, is the market good? And start asking, is my system sound? As we begin to wrap up this episode, let's bring these concepts back to a practical, actionable summary for your family. We started with a contradiction, the confusion of seeing a good investment return but a bad personal result. We resolved this with a both-and solution. We need to look at both the time-weighted return, the report card for the fund, and the dollar-weighted return, the report card for your behavior. This insight is the first step toward building confidence. Instead of abandoning a sound investment because of a disappointing personal result, we can focus on the real issue. We can look at the mirror instead of the window. If you find that you have a negative behavior gap, if your personal returns are lagging the market significantly, it is not a sign that you are broken. It is a sign that your system needs adjustment. It means we need to design simple, sustainable systems that make wise behavior easier and emotional mistakes harder. This is the heart of what we do at SafeSimpleSound. We partner with families to create an environment where the Trustworthy Tortoise approach becomes the default, not the exception. So, here is your educational challenge for the week. Many brokerage statements actually show both of these numbers, though they might be buried in the fine print or labeled as personal rate of return versus benchmark return. Find them, take a look. Is your personal dollar-weighted return higher or lower than your investment time-weighted return? What story does that number tell about your behavior over the last year? Remember, this information is presented without judgment. It is simply data. and data is a tool for understanding and empowerment. This episode draws from our recent blog post, Are You a Good Investor or Do You Have a Good Investment?, which you can find at SafeSimpleSound.com. There, you can see the written framework and the visual examples of the math we discussed today. Through our S3 approach development, we've created resources specifically designed to help families close the behavior gap. If today's insights resonate with your family's situation, if you see a bit of reactive Robert in your own history and want to move toward steady Sarah, we invite you to explore what financial planning could look like through our Safe, Simple Sound practice. You can schedule a clarity diagnostic directly through our website. This is a conversation, not a sales pitch, to see if our framework aligns with your life. But either way, whether you engage with our practice or not, you are now equipped with a powerful capability. You now know that you are the driver, and you have the power to improve your ride, regardless of the road conditions. Thank you for listening to the Safe, Simple Sound podcast. We look forward to helping you navigate your financial life with safety, simplicity, and soundness.